We hear digital gold a lot with Bitcoin, right? And, well, it points to the scarcity, sure, but it kind of misses the why. Why was this thing even created?
Exactly. It's more than just scarcity. It's about um, a reaction, a digital answer to problems in the traditional money system.
Right. Bypassing the usual suspects, the banks, the middlemen. That's the story we're really going to dive deep into today.
Yeah, our goal here is to give you a really clear picture of Bitcoin, where it
Hmm.
came from, the tech behind it, and the economics that make it valuable.
We're talking origins, the tech, the whole deal.
We've looked at the original white paper by Satoshi Nakamoto, the economic climate back then, the core ideas, basically helping you get what makes Bitcoin. Well, Bitcoin, with that getting lost in the weeds.
Okay, so let's kick things off. For ages, money's been centralized, governments, banks, they're in charge. And mostly, okay, fine.
Not always perfect.
Not always perfect, yeah. Think about governments printing more money. That waters down the value of your savings, potentially.
Definitely a concern. Inflation risk.
And then there's access. Not everyone can just walk into a bank. Plus, sending money internationally. Fees, delays, and privacy. The traditional system isn't exactly designed for total privacy, is it?
Not at all. So Bitcoin arrives on the scene, and it's pitched as this completely different thing.
Right. Peer-to-peer, direct person-to-person transactions, no need for a bank in the middle.
And the big keywords: decentralized, secure through cryptography, and crucially, scarce, a fixed supply. Addressing those old problems head on.
Precisely. And the timing was, well, interesting. Right in the thick of the 2008 financial crisis.
Yes. Enter Satoshi Nakamoto. Still anonymous, this paper drops. Bitcoin, a peer-to-peer electronic cash system.
And it wasn't just an idea, it was a blueprint. A system for online payments without needing to trust anyone but the math, the cryptography. No third parties needed.
It's pretty wild when you think about it, just trusting the code, and still nobody knows who Satoshi is. A person, a group. That mystery adds to the legend, doesn't it? Yeah. But the core idea to crustless transactions, that was the real revolution. Sending value online without needing a validator in the middle.
And then, boom, January 2009, the Genesis block is mined. Bitcoin is born.
The first block on the chain, the beginning of the ledger.
So let's really focus on this decentralization thing.
Okay.
Because that seems to be the absolute core difference maker.
It really is. Unlike, say, the dollar or the euro, controlled by central banks and governments.
Yeah.
Nobody owns Bitcoin. No single company, no government. It's run by this huge network of computers spread all over the world.
So no central point of control. That has big implications.
Huge. Think about inflation. Governments can decide to print more money. With Bitcoin, that's impossible. There's a hard cap, 21 million coins, period.
Baked into the code from the start.
Exactly. And transactions aren't approved by a bank employee. They're validated by this network of miners, people running the software. Again, removing the intermediary.
Which allows for, theoretically, freer money movement. More secure, maybe more private.
That's the promise. Decentralization aims to enable all of that. Secure, global money transfer without needing permission from a central authority.
Okay, practical question then. If I want to send you some Bitcoin, how does that actually play out on this decentralized network? It's not like my banking app.
Right, good question. With your bank, or say PayPal, your transaction goes through their central servers. They check your balance, debit you, credit the other person. It's all internal to them. With Bitcoin, when you hit send, your transaction gets broadcast announced to the entire network. All these computers, these nodes, see it.
Like shouting it out to the world, digitally speaking.
Sort of.
Yeah.
Then, these nodes, especially the miners, use cryptography to check if it's valid. Do you actually have the Bitcoin you're trying to send? Is your digital signature correct?
So a crowdsourced verification process.
In essence, yes. Once enough nodes agree it's valid, the transaction gets grouped with others into a block.
A block, okay. And
Yeah.
that block goes where?
That block gets added to the blockchain, which is just this long, public, ever-growing chain of all the blocks, all the transactions, right back to that first Genesis block.
The permanent record.
Exactly. And because this ledger, this blockchain, is copied across thousands of computers and secured by really strong math.
It becomes incredibly hard to cheat the system.
Extremely hard. Tampering with it would require an insane amount of computing power. So you get security, you get transparency, anyone can see the transactions, though not necessarily who made them, and you prevent fraud, all without needing a bank.
Right, that makes sense. So the blockchain itself is the foundational tech. Let's dive into that a bit more. It's more than just a database, right?
Oh, absolutely. It is a digital ledger, yes, recording transactions, But unlike a bank's database, which is centralized and controlled by them,
Yet the blockchain is distributed, spread out everywhere.
correct, across this huge network. And the crucial part is the chain. Transactions get bundled into blocks, and each new block gets mathematically linked to the one before it using cryptography.
Like actual chain links, so you can't just swap one out easily.
Precisely. Each block contains a cryptographic hash. Think of it like a unique digital fingerprint of the block before it. If you try to change anything in an old block.
It changes its fingerprint.
Exactly. And because the next block contains the original fingerprint of the one you altered, the link breaks. The chain doesn't match up anymore.
Ah, okay. So any tampering becomes immediately obvious to the whole network.
Instantly obvious. That's what makes it tamper-proof, or at least highly tamper-resistant. Yeah. It's core to its security.
So let's recap the key features then. Decentralize.
No single point of control or failure, trustless transactions.
Transparent.
The ledger is public. Anyone can audit the transactions in real time. Pseudonymous, though, not anonymous.
Secure.
Heavy-duty encryption makes altering data incredibly difficult.
And immutable.
Meaning, once a transaction block is added to the chain, it's practically impossible to change or delete it. Permanent record.
Wow. Okay, compared to a traditional bank database that, someone could potentially manipulate internally, this sounds way more robust.
It's designed to be.
Hmm.
These features working together make the blockchain highly resilient to fraud, hacking, manipulation, compared to systems relying on, well, human oversight and single points of failure.
Okay, let's phrase the transaction one more time, but really focus on its journey onto the blockchain, step by step.
Sure. So person A decides to send Bitcoin to person B. They use their wallet software, input person B's address, the amount, and hit send.
And that's the broadcast we talked about?
That's the broadcast. The transaction details go out to the network nodes. It's now an unconfirmed transaction floating in the mempool, you could say.
Mempool. Like a waiting room.
Yeah, basically a pool of pending transactions.
Yeah.
Miners then pick transactions from this pool.
Okay.
They verify them, check the signatures, make sure person A has the funds. They bundle a bunch of these verified transactions together.
Transfer a potential new block.
Into a candidate block, yes. Now comes the crucial part. The miners have to mine this block. They need to find the solution to that complex mathematical puzzle we mentioned, proof of work.
The race begins.
The race begins. The first miner to solve it gets to add their block to the end of the official blockchain.
And that's when the transaction is final.
Pretty much. Once the block is added, the transactions inside it are considered confirmed, usually after a few more blocks are added on top for extra security. It's now permanent, irreversible, and super resistant to fraud.
Got it. And this whole puzzle-solving thing, proof of work, that's the gatekeeper ensuring only valid blocks get added.
Exactly. Proof of work, or POW, is Bitcoin's consensus mechanism. It's how the decentralized network agrees on the state of the ledger without a central authority. It ensures only legitimate stuff gets added.
So how does solving a math problem prove anything or do any work?
Well, it's less about the math itself and more about the effort required. Think of it like a lottery, but one where you have to perform trillions of calculations per second to buy tickets. Miners use immense computing power to guess solutions to this puzzle.
A computationally expensive lottery?
A very expensive one. The puzzle is hard to solve, but easy for others to check once a solution is found. The first miner to find a valid solution broadcasts it.
And they win.
They win the right to add the next block to the chain. And for their trouble,
They get paid.
they get paid 2 ways. They collect transaction fees from the transactions included in their block, and they receive a reward of brand new Bitcoin. This is how new Bitcoin is created.
Ah, so that's the incentive. It costs a lot in computers and electricity, but the reward makes it worthwhile.
Precisely. It has to be economically rational for miners to participate honestly. The cost of trying to cheat, needing more computing power than the rest of the network combined, is designed to be prohibitively high.
Making the network secure through economic incentives and computational difficulty.
That's the core idea. It makes attacking the network incredibly expensive and impractical, especially given how globally distributed the mining power is.
But it does use a lot of energy, which is a recurring criticism.
It absolutely does. The energy consumption of proof of work is significant, and that's a valid concern and a topic of ongoing debate and innovation.
Okay, so mining is how transactions get confirmed and new coins are made. But why is it necessary? Couldn't we just add transactions?
Good question. Remember, no central bank. In the old world, the bank verifies you have money and updates its private ledger. Bitcoin needs a decentralized way to do that.
To reach agreement without a boss.
Exactly. Mining is that agreement mechanism. It prevents the double spend problem, someone trying to spend the same Bitcoin twice. Miners competing ensures only one version of the transaction history becomes the official one.
So the computational race prevents cheating.
Essentially, yes. It makes it incredibly costly and difficult to rewrite the transaction history or spend coins you don't have or have already spent. It's decentralized security through computation.
Let's walk through mining one more time, focusing just on the miner's actions.
Okay, so transactions are broadcast. A miner grabs a bunch of pending ones.
Checks them for validity using cryptographic rules.
Correct. Then bundles them into a potential block. Adds a reference to the previous block, creating that chain link.
Now the hard part.
Now the hard part, the proof of work. They start crunching numbers, hashing data over and over, looking for that specific solution, that golden nonce that solves the puzzle for their block.
Trillions of guesses per second, potentially.
Across the whole network, yes. Eventually, one miner gets lucky, finds the solution.
Shouts Eureka digitally.
Pretty much. They broadcast their solution and their completed block to the network. Other nodes quickly verify the solution, remember? Checking is easy.
If it checks out.
If it checks out, everyone updates their copy of the blockchain by adding this new block. The miner who found it gets the block reward, the new Bitcoin, plus the transaction fees.
And the process starts all over again for the next block.
And the process starts all over again. Rinse and repeat, roughly every 10 minutes.
So proof of work is this continuous, energy-intensive competition that keeps the whole thing secure and running.
That's it. The difficulty makes it secure, the distributed nature makes it decentralized, and the reward incentivizes participation. The energy use is the trade-off for that security and decentralization without a central party.
You mentioned the reward, the new Bitcoin. Does that amount stay the same forever? I feel like I've heard about it changing, the halving.
Ah, yes, the halving. Very important concept. No, the reward doesn't stay the same. It gets cut in half periodically.
Got in half, why?
It's pre-programmed into Bitcoin's code, approximately every 4 years, or technically every 210,000 blocks mined. The amount of new Bitcoin created with each block, the reward for miners, is halved.
So it started high and keeps decreasing.
Exactly. Back in 2009, miners got 50 Bitcoin per block. The first halving in 2012 dropped it to 25 BTC. Then in 2016, it went to 12.5 BTC,
I took 20.
dropped to 6.25 BTC, and the most recent one, in 2024, brought it down to 3.125 Bitcoin per block.
Wow, so it gets progressively harder to earn new Bitcoin through mining. What's the point of doing that?
It's all about scarcity and controlling inflation. By reducing the rate at which new coins enter circulation, the halving ensures Bitcoin becomes scarcer over time.
Mimicking something like gold mining, where it gets harder to find over time.
That's a great analogy. It's designed to be deflationary, or at least disinflationary, unlike fiat currencies where central banks can print more at will. This predictable reduction in new supply is a key part of Bitcoin's economic model and potential store of value proposition.
So the halvings directly impact the supply side of the equation. Reduced supply, assuming demand stays the same or grows, could push the price up.
That's the classic economic theory, yes. Historically, halvings have often been associated with subsequent price increases, though many factors influence price. But the core idea is increasing scarcity over time.
You also mentioned the mining difficulty adjusts. How does that work?
Right, the network automatically adjusts how hard that mathematical puzzle is to solve. This happens roughly every 2 weeks, or 2016 blocks.
No.
It's
Based on what?
based on how quickly the last 2016 blocks were found. If miners found them faster than the target rate of one block every 10 minutes, meaning more computing power joined the network,
The difficulty goes up.
exactly.
Yeah.
It gets harder to find the next block, slowing things back down towards that 10-minute average. Conversely, if blocks were found too slowly, the difficulty decreases, making it easier.
So it's self-correcting. It aims for that consistent 10-minute block time regardless of how many miners are active.
Precisely. It keeps the block production rate stable and predictable, which is important for the network's rhythm and security. More miners means higher difficulty, which also means the network becomes even more secure because more computational power is needed to attack it.
Okay, let's shift gears slightly to that fixed supply 21 million Bitcoin ever. That's really unusual for a currency, isn't it?
Extremely unusual, especially compared to fiat currencies like the dollar or euro. Central banks can and do increase the money supply, sometimes significantly. That's inflation.
Which erodes purchasing power over time.
Correct. Bitcoin was designed specifically to avoid that. The 21 million limit is absolute, enforced by the code. No more can ever be created. It's mathematically guaranteed scarcity.
So, finite supply, predictable issuance through mining rewards, and those rewards decreasing over time due to halving, it all points towards scarcity.
That's the trifecta. It makes Bitcoin fundamentally different from currencies that can be inflated away.
The comparison to gold comes up again here, right? A limited resource.
Exactly. You can't just print more gold.
Yeah.
You have to find it, mine it, refine it. It takes significant effort and resources. Bitcoin mining, while digital, also requires significant resources, electricity, and computing power. This inherent scarcity is why people call it digital gold and see it as a potential store of value.
Let's just hammer home the halving's role in this scarcity one more time.
Sure. Every halving event literally cuts the rate of new Bitcoin inflation in half. Fewer new coins are entering the system per block. This directly slows down the approach to the 21 million cap and makes the existing coins relatively scarcer.
It systematically tightens the supply flow.
Precisely. Which, again, according to supply and demand, could influence its value, especially as adoption potentially grows against this shrinking new supply.
So, how does this unique supply dynamic interact with demand to determine Bitcoin's value?
Well, it's the classic economic dance. You have this strictly limited and increasingly scarce supply. On the other side, you have demand, which has generally been growing over time from various sources, individuals, investors, companies, even some governments are exploring it,
More people wanting a slice of a limited pie.
essentially. And market psychology plays a huge role too, of course. If people believe Bitcoin is valuable because it's scarce and useful, that belief itself drives further demand. Historically, this combination of program scarcity and growing adoption has tended to drive prices upward over the long term, reinforcing its narrative as a store of value.
So, let's contrast that directly with traditional fiat money again.
Okay. Fiat currency value relies heavily on trust in the issuing government and central bank. Its supply can be increased or decreased based on policy decisions.
Subject to human decisions and potential inflation.
Right. Bitcoin, on the other hand, is decentralized. Its rules are set in code. Its supply is capped at 21 million. Its value proposition rests on mathematical scarcity and cryptographic security, not trust in institutions.
So, it operates on a completely different trust model math versus institutions.
You could put it that way.
Yeah.
And this difference is why some investors use Bitcoin as a hedge against potential inflation in the traditional financial system, much like they might use gold.
Looking forward, then, Bitcoin's journey has been pretty wild. From this obscure cypherpunk experiment.
To something discussed in boardrooms and by major financial institutions, it's been quite the evolution. Initially, it was mostly about peer-to-peer payments, this niche digital cash.
But the narrative shifted.
It did. As people understood the implications of decentralization, and especially the fixed supply, the digital gold, or store of value narrative, gained significant traction. Institutions started looking at it as an inflation hedge, a potential long-term asset.
So let's focus on buying coffee with it, more on holding it like gold.
Increasingly so, particularly for larger players. Major companies have put it on their balance sheets. Investment firms offer Bitcoin products. It's become recognized as a distinct asset class, largely thanks to that scarcity and decentralization.
What about broader adoption worldwide? Are we seeing more integration?
We are seeing definite signs. Some major businesses like Microsoft have accepted it at various points, though sometimes policies change. Tesla famously bought Bitcoin and briefly accepted it for cars.
Right, I remember that.
More significantly, perhaps, you have countries like El Salvador actually making it legal tender. That's a huge step. And the institutional adoption, with giants like BlackRock and Fidelity getting involved, really signals a move towards mainstream financial acceptance.
No, but it's not all smooth sailing. There's still hurdles, right?
Oh, absolutely. Big challenges remain. Scalability is one. The network can get congested and transaction fees can spike during busy times. Makes small payments impractical sometimes. Regulatory uncertainty is huge. Governments globally are still figuring out how to treat Bitcoin as currency, commodity, property. The rules are still being written, which creates risk.
And the environmental issue keeps coming up.
Yes, the energy consumption of proof-of-work mining is a persistent concern and a target for criticism. Finding sustainable solutions is crucial.
But there's work being done on these problems. Innovation's happening.
Definitely. There's a lot of development. The Lightning Network is a prime example. It's a layer 2 solution built on top of Bitcoin to allow for much faster, cheaper transactions off the main chain.
So trying to fix the speed and cost issues.
Exactly. And other layer 2 solutions are exploring ways to increase capacity without sacrificing Bitcoin's core security. On the energy front, there's a noticeable push towards using renewable energy sources for mining and exploring less energy-intensive consensus mechanisms for other crypto projects. though Bitcoin itself remains committed to proof of work for its security guarantees.
So these improvements could make Bitcoin more practical, more sustainable.
That's the goal, to address the valid criticisms and make the network more efficient and accessible for the future.
Which brings us to the big questions. What does the future hold? Will Bitcoin hit true mass adoption? Could it actually, challenge traditional banking?
Those are the multi-trillion-dollar questions, aren't they? It's impossible to say for sure. The financial world is changing so fast.
But Bitcoin's impact is already undeniable.
Undeniable. Its core ideas, decentralization, scarcity, censorship resistance, secure value transfer based on math, these have already fundamentally shifted conversations in finance and technology. It's proven itself as a major 21st century innovation.
Whether it takes over the world or finds its niche, it's changed the game.
It really has. Its story is definitely not over yet. It could become the backbone of a new financial system, or coexist with the old one, or maybe even evolve into something we haven't even imagined.
So we've covered a lot today, from Bitcoin's birth out of a desire for decentralized money to its tech, its unique economics, and its current place as this digital store of value.
Yeah, it's clear Bitcoin has shaken things up. It challenges how we think about money, trust, and control in the financial system. Whether you see it primarily as an investment, a payment network, or something else, its influence is profound.
And so, as we wrap up, we'll leave you with this thought. Where does Bitcoin go from here? Will it integrate further and maybe even dominate global finance? Will it settle into a specific role alongside traditional systems? Or is its evolution leading somewhere entirely unexpected? The next chapter is still being written.